Live. We'll give this just 10 seconds or so to connect. And it looks like we've connected, which is excellent. So we are live once again, which is fantastic. We've got TradeStation back. More specifically, David Russell joins us again. He's the global head of market strategy at TradeStation. And if you've been following these live shows with David, you are probably much more informed about the recent moves in markets, what to watch for, and also some upcoming events. Now, one really important thing I want to say on this live stream is that David is also the man behind the TradeStation account on TradingView. He is the one writing all of the ideas, publishing all of the charts. So if you come across the TradeStation account on TradingView, see some of those excellent charts, well, guess what? You've also now met the man behind the account. So definitely ask questions, give him some boosts, write some comments. You've got direct access to their global head of market strategy. One more thing I want to say is that this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures options, and cryptocurrencies markets. And as many of you know, TradeStation is a connected broker on TradingView. So you can connect your TradingView account to your TradeStation account and do everything you need directly from the chart. So without further ado, I need to pass the mic to David, because before we dive deep into markets and get you the expert look you need, David's got a few things to say.
Yes, well, thanks a lot, Steph. It's great to be with everyone again. I am showing you the standardized returns of a series of ETFs, so you want to look at them quickly. I'm going to reference some of these ETFs, and I just wanted to share these standardized returns with you. I also wanted to tell you that there are disclosures for them. If you go to tradestation.com/insight/ETF-disclosures, we provide a link to the disclosures of some of the different ETFs we're going to be talking about. So I wanted to just let you know that. Just wanted to share that. This is the TradeStation platform, but we're going to be mostly using TradingView for this. So, all right.
Perfect.
Well, I want to actually start off. Thank you, Steph. I want to just start off by mentioning that, in my view, in the last couple of weeks since the beginning of November, we have seen an epic, historic change in the market. We saw. There's a survey from the American Association of Individual Investors that went from, a very bearish to a very bullish reading. And the number of people who called themselves bullish increased by 18 percentage points 2 weeks ago. That was the biggest increase since 2010. The number of people calling themselves bearish dropped by 23 percentage points, which was the biggest decrease in bearishness since June of 2003. So we really saw a significant change around a lot of things. First of all, a lot of the problems in the Middle East did not blow up the way people had feared they would. But also, we saw a real change in the economic data. We saw productivity and unit labor costs show significant slowing of inflationary pressures. We saw things like the Institute for Supply Management Service Sector Index show significant weakening. And especially what caught my attention was when people order business services, the turnaround time is much faster than it was. That means that there's more slack in the economy. It means that there's less opportunity for companies to raise prices. It is deflationary. We also saw things like that in transportation companies that issued earnings. They said the same thing. We also saw things with unemployment higher than expected, wages lower than expected. We saw job growth in the previous 2 months revised lower by 100,000 jobs. And on top of all that, we saw oil really move to the downside in the last few weeks. So you put all those things together, and the inflationary narrative that has haunted the market really all year, or especially since the summer when the 10-year went shooting higher, that has really gone away quickly, and it has created a big change in sentiment. And in my perspective, this is a major thing we need to be aware of. And we could see a kind of spreading across the market of some potentially bullish things. So,
well, David, one thing I have to say about that, which is directly related to the chart that you're showing, and some viewers may recall this, I would say, I think it was 2 episodes ago, so 2 months ago, you had pointed out that it has been over 650 days since the S&P 500 had made a new all-time high. Or maybe at that time it was 630 days, something around that marker. And I've been following that stat rather closely since you pointed it out. And it is now the longest streak since the financial crisis, right? So when I hear these sentiment readings, I think about that in the sense of, wow, we've been going sideways for quite a long time.
That's right. And what's interesting, if you look back to the financial crisis, so now we're looking at a monthly chart of the S&P 500. And what's interesting to me is if you look back, we went through periods of time of about 20 months on various occasions that we moved sideways before we broke out to new highs. And what's interesting here is we're at roughly the same interval. We had this high at the very beginning of last year, and now we're at about 22 months. This is a monthly chart. And so for me, this is actually very interesting because if we are going to get a breakout and continuation to new highs, the timing does match up with things we saw previously. Now, what I like about this is that this chart shows a long-term, this is a logarithmic chart, but these are monthly candles. And if you look, what's very interesting to me is this was about a decade ago where we really broke out to new highs in April of 2013 above the previous highs from 2007. So this bull market, if it's a secular bull market, is about a decade old. Now I want to go back to the 1980s and 1990s. The S&P broke out to new highs, in the early 80s, and about halfway through that bull market, I mean, it's not exact, but we're talking about 10 years, you had this big pullback in 1994, 95. At that time, there was a high inflation. The Fed was raising interest rates, and then inflation faded. And we had a couple of things happen. We had a soft landing in the economy. We had technology stocks take off. So what's interesting is we have a similar environment right now. We also saw extremely negative sentiment at this moment in time. And we basically had this great run in the late 90s. So the bull market was about 10 years old and it had its final kind of flowering in the last 5 years off of a long-term monthly trend line. Well, we've been holding a similar sort of trend line. The other thing that's interesting to me is that millennials are now almost exactly the same age that baby boomers were in 1995. They're in their mid to late 30s, so they're now matching up in the same sort of time frame in terms of family formation, saving for retirement, and everything else. So I see a lot of similarities here. This is something on the monthly chart. Now, I want to just jump over real quick on the weekly, because what's interesting here is that we basically see that this trend line really got broken yesterday and today. And from my perspective, this is now setting us up for something that is, more of a confirmation that the longer term has turned more bullish, or at least the longer term is not at this point bearish and doesn't support the idea of a more of a bearish move. I'm going to jump over now to the S&P.
David, I really do quickly want to comment on that for the new traders and investors watching, which is you just gave an excellent example of, some call it analogs, a chart analog, whereby you have found a point in time that matches the current process or trend. And for the new traders and investors out there, there's a lot of famous investors who often say, history is really all we have as our guide for price action. So that was pretty fascinating to see that analog demonstrated in real time. And the stat about millennials being the same age, I think, as you said, baby boomers, is that right?
Yeah.
It's fascinating. Like, a lot of things match up. The trend line matches up, and the sort of formation of an important.
And I will just mention, some of you probably noticed, well, how about this? This breaks a trend line. I'll just mention that this was the COVID crash, which was the craziest event in the history probably of the American stock market. Nothing, even the crash of 1929, doesn't compare to the speed of going from an all-time high to a massive bear market in 2 to 3 weeks. So that was such an aberration in history that breaking the trend, to me, in this case, can't be ignored. I wanted to just mention that this was the COVID crash of March 20. So I think we can dismiss that. So I wanted to just emphasize if anyone was asking questions about that.
Yeah.
Steph, one thing one of the things I look at, and I've told some of our clients, we do a weekly webinar here at TradeStation. And one of the things I talked about a few weeks ago, we're not looking at the daily chart of the S&P 500. Now, what's interesting to me is it, I sometimes look at the 20-day, the 30-day, and the 50-day moving average, not for any, really precise signals, but I often try to think in terms of short-term, intermediate term, and long-term. So right now, I would view this as an intermediate term signal. And at this point, you could see that the 20 was under the 30 was under the 50. This gives you a clear sense that there was an intermediate term downtrend. If you look back here at this point in time, you'll notice that when they all lined up the opposite way, we had a nice intermediate term move. When I say intermediate, I mean 3 to 6 months. So at this point, we had a kind of, real confirmation of intermediate term bearishness, and we had to finish that out. But now we're at a spot where that intermediate term bearishness has basically been broken. So I think right now we're seeing is we know that we have a short-term bullish trend. We have the intermediate term trend it's at least now neutral to bullish. And the longer term trend with the breakout of this trend line is also more bullish. So what we're seeing now is we had a market here that was an intermediate term bearish trend. That had to play out. But once it played out, that's over. And now the longer term trend reasserts. It was also interesting to me to see this level from late May that held as support.
So you moving averages, your application of them, I think, is spot on to look for those types of trend changes, especially the speed of the trend. And as those crossovers start to happen among them, I've noticed, and I would have to look at the back test stats, but it oftentimes does sort of dictate the speed of the next move. So that's interesting. So what do you have there? You've got the 200, the 50, the 20, and the 30?
Yeah. And the 200 just shows that the longer term trend never really got bearish. But this just showed right here, we were talking at the time to people about how this was a very problematic place to be hoping for more near-term upside. And the reason is we had this gap here. This was that last Fed meeting when the Fed added a rate hike to their forecast. So you can just see that this thing played out. But I think the most important thing is that, it played out and now it's over. Very often something it kind of has to do what it's going to do. The trend has to, achieve its fullness. And in many ways it did that here. And then all of the reasons for that trend in terms of higher interest rates, inflation, was basically invalidated as we got here, because all the data I talked about earlier, it all hit the market in here. And this snapback was happening as that economic data came out that was more dovish. And then you can see we cleared that level kind of yesterday, and now today, this entire move now is history. And we've entered, this entire thing that we've seen since July, in my opinion, is now more or less gone. I mean, we still have these levels as resistance that can have some impact, but this intermediate term downtrend is now over. And we can be thinking about what will be coming over the next few months.
And before we move on to the next chart, the 200-day moving average, I think some people know this already, but just say it again. I know I've heard a lot of traders, from Paul Tudor Jones to others, talk about the long-term significance of the 200-day moving average. It's sort of your, ultimate zoom out to see a longer-term trend without zooming out too much. It's like the perfect combination, apparently, of moving averages for long-term investors. So that's a nice sloping 200-day moving average, I must say.
They're great. And now what's interesting is I want to talk about the euro. And this is interesting because I've been watching this, and when you and I were on last time, we were actually kind of, I can't remember what we said, but we definitely looked at it. And I wanted to revisit, because one of the things to me that was interesting is we had done an idea on TradingView a few weeks back. We saw this trend line break, and we saw this hammer. And what's interesting is now to see that we tried to break under the January low. Now, it's always interesting if you hold your low for the year. Like, we tried to make a new low for the year, didn't happen. And that actually often is a false breakdown. And just the fact alone of having a false breakdown, that is an event on the chart. There are people who, probably sold that low and are hating life because of it. There are people who bought that low who, are now in a positive position. But a false breakdown alone is a meaningful signal. And we had one right here at the beginning of October, which coincidentally is also the beginning of a quarter. And if you look back last year, we also, our low on the euro was essentially the same time at the very end of September, beginning of October. So it's interesting that you have some, sort of quarterly things happening. It's also interesting to see that we had kind of squeezed between these levels and the low for May before we broke out. So to me right now, we're seeing something, if you look at the euro in the longer term, that the fact that we held this low for the year here actually means that the euro may have now established support above this 104 level, this kind of 105 level. And to me, that's actually kind of significant because we've had this period, if you look at it, of the euro being weak, not just for, a year, but really for a decade. The euro has been under pressure really since, well, more than a decade. So, I mean, you're looking at something here where it doesn't mean that it has to turn into a new bull market in the euro, but it could be strong for a couple of quarters, and that can have a big impact on the market overall. And we're going to get to this, but my thought is that we're at a spot now where we could be seeing more of a rotation toward weak dollar sort of trades, more of a rotation away from just the Magnificent Seven stocks that had kind of dominated the market. And a weakening dollar could lift a lot of ships. And the euro, I think, is a key thing to watch. I've been watching the euro as a big indicator.
David,
I want to ask.
I want to just quickly comment because that was very, very cool to see with the euro. First of all, I see the I see the weekly red candles there and the consecutive nature of all those red candles. Wow, that is you don't see multiple red candles like that on a weekly time frame that often. Secondly, your application of zooming out to get the longer term trend, that was perfect. I had forgotten the euro was in a downtrend for all this time.
So we have one thing that I love about, TradeStation has it and TradingView has it, is these custom indicators. And one of the ones that I've created is I call it price streak. It's relatively simple. It just counts consecutive candles in one direction. This drop in the euro was the longest losing streak since, the euro existed in some version since the 70s. It was probably something from the old German mark or something. But this was the longest losing streak in the history of the euro that we actually see here highlighted. So you make that point, and it was just there. I wanted to show you guys as well that this was a historic drop. And, that is, from my perspective, something like that can just show that this entire sense of dollar strength, Fed hiking, that entire narrative played out. And what did it do? It couldn't even make a new low for the year. And that tells me that this thesis of dollar strength has played out. It's over, and people will now sentiment will be looking in a different direction. So that's the weekly.
Great.
And let me just
say great indicator, because I agree with you. It does seem like that's a moment of, hey, that type of downtrend setting a record is sort of a form of capitulation, really. Even though price didn't do it, the trend sure did.
And in many ways, it's not exactly divergence, but it's the same idea of divergence. Because what you have is a trend that is losing its intensity, but it still has a kind of zombie drift before it finally ends. And you often see that when a stock is topping out, when it will kind of keep going up and hitting highs, but not doing anything new. And it will go months and months. And then something happens and it just starts tanking. Like, look at General Electric before it really had the sell-off about 4 or 5 years ago. It was just sitting at highs, and then the sellers came in. And so it's interesting is the euro was just going down, hitting lows, but nothing new was really happening. And then boom, the buyers come in. This is the daily, and it's interesting to see this little pattern here. And actually, if you look here, this level from the May low, another thing I love about this platform is where you can just copy your lines from one chart to another. So if you look at this May low, look how we held that basically in the last week or so. So we have, these highs is the May low, and then also the highs from late October. Resistance becomes support. This really tight little consolidation with this huge breakout today. I think this is the biggest rally in the euro in a year since the exact same CPI report a year ago in November. We had a soft CPI reading for October. We had a rally in November based on that, similar sort of thing. So we broke above that. Now I got to show you this thing with the dollar index, because to me this was huge. Look at this channel. And what I think is interesting, this is the dollar index, the opposite of the euro. On a daily chart, you have the 50-day moving average, but on top of that, I always like to see when you have a channel, it's moving in a certain direction, and then you only make it halfway up in the channel. So in this case, we didn't even revisit the top of the channel. We basically died at the midpoint. And so to me, that is also something now that this is a little downtrend, but when you die at the midpoint, it actually tells you that now the trend accelerates. So to me, this is actually a really significant chart to see this failure at the midpoint.
I have to say that red candle on DXY that you just had up, that's one of those candles that you just can't ignore. I mean, it breaks the channel perfectly, and it looks like it's probably one of the largest candles that the dollar index has had in quite some time. So that is absolutely on the radar. And that green line, is that the 200-day as well? The green moving average. So there's something interesting brewing here, and that break is significant. I'm right there with you. Wonderful charts. And quickly, for the new traders and investors watching, kind of a theme of our show as well, to help them out, you mentioned about the ability to copy and paste drawing tools. And I must say that's such an important thing to keep in mind that you did just demonstrate, is that if you draw on a chart the same way you might use your keyboard shortcut or right click and then copy, you can do that with any drawing tool that you place on your chart. It's just like a Google Doc, copy and paste. And I do think that's important for people to remember, because you can take these drawing objects from historical moments and paste them exactly where you need them without having to redraw them. So I'm right there with you, and it's a great charting technique for traders and investors.
And they'll go, I love how you can draw something on a daily chart, copy it from a daily chart, go to an hourly chart and paste it, and it'll fall in exactly the right spot. So I want to now just quickly say the same thing, dollar index. Now we're looking at a weekly chart. I put in the Fibonacci 50% retracement. Look at that. We basically hit the 50% line on the drop that came from we basically saw the dollar index, fall last year, almost exactly the same time. It started falling, like I said, October, late September of last year. The dollar had a move down. We retraced exactly half the move in terms of the bounce that we had since this summer. So this is also something I think is interesting. It confirms, again, a false breakdown can confirm a move in the opposite direction. And in many ways, a 50% retracement that holds can confirm a move in the direction of the initial move. In this case, lower for dollar index. Failing the 50% retracement of that confirms in many ways the potential for downside in the dollar and the potential for upside in the euro and global assets.
And David, maybe you could quickly tell all the investors and traders out there why a weak dollar can spur a bull market of sorts.
Well, one reason off the bat is the dollar is historically the safe haven. If you have money and you're, quote, in cash and you don't want to take risk, you have money sitting in your dollars. So that in and of itself means that the dollar is a safe haven. So if people want to take risks, they have to sell dollars. If you have $10,000 in your brokerage account and you buy Apple with it, you just sold dollars. Whether you recognize it or not, that's what you did. So when you take risk, you historically are moving away from dollars. Another reason is that a lot of commodities are priced in dollars. And also, if you're a company, the value of the business that they have overseas actually grows as a result of the dollar weakening. It's like if you own an apartment or a house in France and the dollar goes down, well, you didn't do any work, your house just gained value. So the thing is that there's a historic relationship, an inverse relationship between the dollar and foreign assets, and also metals. And that's one of the things I actually wanted to turn to next. So I think it's important to realize that the main thing is that dollar is the risk-free asset for the most part in the world of investing. So when the dollar weakens, it means people are taking risk.
It's such a forgotten practice or concept within markets because we often get so zoomed in on one or two symbols specifically that we forget that some of these macro plays do ultimately determine the bullish or bearish direction of the entire market. So that dollar educational tutorial that you just gave us, wonderful. And what's this trend line? Tell us about this.
I just did a monthly here just to show that the low that we actually hit last year was below the high of the dollar in at the beginning of this century. I remember this. This was basically before, right when the United States was entering a recession around September 11th of 2001. A recession had started. The Fed started cutting rates, and the Iraq War was beginning. As this happened, basically money started flooding into global assets and away from the dollar. And so this was a peak. And if you look at it, we went back and we've now made on the long-term chart a lower high. So to me, this is also something that confirms that, over the longer run, it's not to say we're going to go back down to the dollar weaknesses of where it was in 08. But this suggests to me that there is space to the downside on the dollar, and that could fit into the thesis. I think it's important with currencies. You seldom see a currency just truly run the way like a stock like Apple will just keep making new highs, or Nvidia. They tend to be, even if they're in long-term ranges, they tend to be essentially in ranges. And I think we see this here, that historically the dollar is in a range, and at this point it could have more space down the range.
Yeah, that is definitely in that case a range to watch. And I have to ask, based on these dollar movements, where do you think that, what sectors or industries are sort of percolating or showing the strength or even weakness that we should be aware of?
Well, off the bat, the ones that, and I just did an idea on this that we published earlier today about gold and copper. So to me, these are now in a spot when they have these converging trend lines, and they don't have confirmation yet, but there is a lot of potential for these to break out. And in my view, what's interesting is that these have not gone down as much as you would expect when you consider the strength of the dollar. So I'm watching things like the metals that I think could have a significant move. Another one that I'm about to publish an idea on is UBS, because UBS is a major European bank that they were actually involved in taking over some of Credit Suisse's assets after the whole blow up earlier this year. And this is one I'm going to be doing an idea on it tomorrow, but we basically have this trend line that it broke through, and the way it's holding, if you look, it broke above this old high from March. Major European bank. So from my perspective here, I'm looking at global equities, kind of everything, emerging markets, European stocks, because at this point in time, I think there's a potential that if we see the dollar weakening, it has the potential to lift all those global assets. And if you look at global equities from that moment back in 2001, 2002, that is when you saw these huge moves in emerging markets over the following 4 to 5 years. And if we are in a period where the Fed is truly done, the other thing that's interesting to me is that emerging markets and international stocks have lagged for decades, and they were more than a decade, and they trade at low multiples. So I'm watching. I'm not sure where it's going to be yet, but I'm now thinking from a macro perspective that we have that potential for movement into the global stocks that could last several quarters.
So I have to say, going back to the silver chart, because I want to talk about both these charts. I was not expecting you to show silver and UBS, but for silver, if I understand correctly, the silver is holding up more than maybe anticipated. Is that sort of the thought process here?
Yeah, if you look at it, the dollar. I mean, let's look very quickly again at the dollar over this same time frame. The dollar basically, hit this high back here in September, and look at silver. I mean, silver really, even at that same time, silver barely pulled back. So for me, what's interesting here is that the dollar has been strong, really, all for several months, and silver has barely moved down. So what happens if we start to see a sustained downward move in the dollar? based on history, it would be favorable for silver. And when you look at this converging sort of triangle, it's interesting because, Bitcoin does things like this too on the daily chart. It will squeeze down, fail to break lower, and then explode higher. So I'm not saying it's confirmed yet, but I see the potential for these metals to really come to life. And so I think this is one thing I'm looking at as a potential opportunity, and I'm waiting for confirmation on it.
And for confirmation for you, would it be a breakout of this sort of long-term support line you've got drawn in that downtrend in the resistance there?
Yes, I have levels in the actual idea. If we actually look, I have the idea over here that we published on TradeStation ideas, and we identified some levels. I said it would be a close above the October high around 2370 on silver.
Wow, and that copper chart is so interesting as well, because copper looks like it's doing something similar.
Exactly, that's the thing. So I just think these are very interesting when we look at them, to realize that, to me, the key thing is that we had a strong dollar, we had an incredibly aggressive Fed hiking cycle, and we didn't see the metals collapse. So what happens when the Fed stops hiking and we see that pendulum swing the other way? Very often what I think is interesting is when you see stocks that hold up in a bad market, because those are very often the ones that, when sentiment turns, really take off. Now, we actually did some ideas. I'll just really quickly show you, but if you look at CRWD, we did this one a few weeks ago back here, and the rest of the market was under its 50-day moving average. It was just, at the lows in late October, and this stock was right around here. I think we did the idea here. It went a little bit lower, then it took off. There was another one that we did that was like this, SNPS, I think. One is a cybersecurity stock. SNPS is a semiconductor software company. Both of these were basically above the 50-day moving average, when at the same time the S&P 500 was under its 200-day. So what's interesting to me is that when you see something that's holding up good or holding up well in a bad market, when the market improves, they often really take off. So that's what I think is interesting about gold, about silver and copper here.
I have to say I just want to talk about all those charts as well that you were